Most people lose money in the stock market, not because they pick the wrong stocks, but because they pick the wrong moments. They panic, they sell too early, they buy too late, and then, they swear off investing forever. But here's the truth. Markets don't destroy wealth, emotions do. Today, we're diving deep into why 80% of investors panic and lose money, the psychology behind financial decisions, and the hidden patterns that keep people trapped in the same cycle, over and over again. Because once you understand this, you'll never look at investing the same way again. Let's rewind to March 2020. The world was shutting down. Markets were crashing. The headlines were apocalyptic. Millions of investors, from retirees to first-time Robinhood traders, sold everything. They couldn't handle watching their portfolios bleed red anymore. But within just a few months, those who didn't panic, those who stayed calm, saw the markets bounce back stronger than ever. The S&P 500 not only recovered but went on to hit record highs. The difference between the ones who lost everything and the ones who built generational wealth. Emotion. That's the story of investing, fear and greed, repeated across decades. And it's not just about 2020. It's the same story in 2008, in 2001, in 1987. Every crash is the same test, and most people fail it. There's an old saying on Wall Street: markets are driven by fear and greed. But what most people don't realize is just how true that is, and how deeply wired it is in our biology. Because when you strip away the numbers, charts, and financial jargon, investing isn't just about strategy, it's about psychology. Every single day, trillions of dollars move through the markets, but those trades aren't just data points, they're reflections of human emotion. And it's that emotion, fear, euphoria, regret, FOMO, that quietly decides who wins and who loses. In fact, according to studies by Dalbar and other behavioral research firms, the average retail investor consistently underperforms the market by a staggering margin. Not because they lack information, but because they can't control their reactions to it. So, let's dive deep, because understanding this isn't just about avoiding mistakes. It's about rewiring the way you see the market, the way you feel risk, and the way you respond when everything around you screams, sell. Imagine this. It's 2020. The market crashes overnight as COVID spreads across the globe. Panic grips investors, portfolios evaporate, CNBC flashes red tickers, and Twitter fills with predictions of an economic apocalypse. Now pause for a second. What did you feel reading that? Anxiety? Maybe a memory of watching your own portfolio drop? That right there, that instinctive fear response, is exactly what drives most investors to make catastrophic decisions. Because the market, more than anything else, is a psychological feedback loop. Here's how it goes. When prices start rising, optimism grows. Investors feel confident, they buy more. As the market continues to climb, confidence turns to excitement, and excitement turns to euphoria. People start saying things like, "This time it's different." They stop thinking about risk because the crowd makes them feel safe. Then comes the peak. The exact moment when greed is at its highest and risk is at its maximum. And then, without warning, something shifts. Maybe it's a disappointing earnings report, or a rate hike, or a geopolitical event. Prices fall just a bit, but fear spreads faster than reason. Optimism turns to anxiety. Anxiety turns to panic, and suddenly, the same investors who were shouting, "Buy the dip," are rushing for the exits. It's not logic, it's biology. When you see your investments drop, your brain activates the same survival circuits used when our ancestors faced predators. The amygdala, the brain's fear center, lights up. It releases stress hormones. Your body literally enters fight or flight mode. And in that state, you're not making rational decisions about your long-term portfolio. You're just trying to stop the pain. So you sell, you lock in losses, and when the market finally recovers, as it always does, you're too afraid to get back in. This is the psychological trap that 80% of investors fall into. One of the cruelest tricks the market plays on us is giving us the illusion of control. Every day, investors check their portfolios, watch charts tick up and down, and feel like they're doing something. But the truth is, the more you try to control the market, the more it ends up controlling you. Behavioral finance calls this activity bias. It's the belief that doing something, anything, is better than doing nothing. But in investing, the opposite is often true. Think about the best investors of all time: Warren Buffett, Charlie Munger, Jack Bogle. Their edge wasn't timing. It wasn't fancy trading algorithms. It was patience. They understood that markets are designed to transfer money from the impatient to the patient. The average investor, however, can't sit still. When the market dips, they sell to protect gains. When it rallies, they chase performance. They jump from stock to stock, fund to fund, trying to outsmart everyone, and end up underperforming nearly every benchmark. In one famous study, Fidelity analyzed their top-performing retail accounts and found something shocking. Many of those accounts belonged to dead investors. Why? Because they weren't trading, they weren't reacting, they simply let time do the work. That's the brutal truth. Your emotions are the single greatest threat to your financial success. Not inflation, not taxes, not Wall Street manipulation, you. But if our brains are wired for fear, the media acts like a megaphone. Financial media thrives on attention, and nothing grabs attention like panic. You'll never see a CNBC headline that says, "Markets fluctuate, long-term investors remain fine." Instead, you'll get, "Stocks plunge, billions wiped out in minutes." That language isn't designed to inform, it's designed to provoke. Because fear drives clicks, clicks drive ratings, and ratings drive revenue. The cycle continues, and investors become trapped in a constant state of anxiety. It's called availability bias, the tendency to overestimate the likelihood of events that are most recent or emotionally charged. So when the market crashes, it feels like it's always crashing. You forget the decades of upward growth, the compounding returns, the resilience of capitalism itself, and fixate on the pain of the present. The smartest investors learn to disconnect from that noise. They understand that the media isn't an oracle, it's a business. And its business model depends on keeping you emotional. So the next time you see a headline that screams disaster, ask yourself, who benefits if I panic? Because the answer is almost never you. Let's take a step back and look at history. Every major crash, 1987, 2000, 2008, 2020, felt like the end of the world while it was happening. But in hindsight, every single one was an opportunity for those who stayed calm and stayed invested. If you had invested $10,000 in the S&P 500 in 1980 and simply held, reinvesting dividends, you'd have over $1.5 million today, despite wars, recessions, and global crises. But the problem is, most investors never give time a chance to work. They interrupt compounding with panic. And compounding, that quiet, invisible force, only rewards the patient. The longer you stay invested, the more your money grows exponentially, not linearly. But every time you sell in fear, you reset that clock. It's like planting a tree, then cutting it down every time a storm passes through. You'll never enjoy the shade if you keep chopping it down before it matures. Behavioral biases that destroy portfolios. Let's talk about the specific psychological biases that quietly erode investor wealth. First, loss aversion. Psychologists Daniel Kahneman and Amos Tversky found that people feel the pain of a loss twice as intensely as the pleasure of a gain. That means a 10% drop feels twice as painful as a 10% rise feels good. So when investors see red on their screens, they overreact, even if their long-term strategy remains sound. Then there's herd mentality. Humans are social creatures. When we see others buying, we want to buy. When we see others selling, we feel unsafe holding. This instinct kept our ancestors alive, but it kills portfolios. Because the crowd is almost always wrong at turning points. And finally, recency bias. We give too much weight to recent events and forget the big picture. After a market rally, we think it'll never end. After a crash, we think it'll never recover. Both beliefs are illusions, but they shape our behavior in powerful ways. Understanding these biases doesn't make you immune to them, but it makes you aware. And awareness is the first step to mastery. Here's the uncomfortable truth. Institutional investors, the ones managing billions, count on retail investors panicking. They understand the psychology of fear better than anyone. When markets crash, they're not selling, they're buying. They know that emotion creates mispricing, and mispricing creates opportunity. When you panic and sell your shares at a discount, someone on the other side is quietly buying them at a bargain. That's how wealth transfers from the emotional to the disciplined. Warren Buffett once said, "Be fearful when others are greedy, and greedy when others are fearful." But that's not just a quote. It's a mindset, a framework that separates amateurs from professionals. Professionals see volatility not as danger, but as a feature of the market. It's what creates entry points. It's what allows compounding to work over time. The average investor, however, sees volatility as a signal to flee. And that difference, in mindset alone, determines everything. There's one illusion that keeps investors trapped in the panic cycle: the belief that they can time the market. It sounds logical: buy low, sell high. But in practice, it's almost impossible. Because no one, not even the top hedge funds, can consistently predict short-term market movements. And yet, retail investors try to do it every day. They wait for the perfect moment to buy. They sell too early or too late. They miss the big moves. And the result? They underperform the very index they're trying to beat. The irony is that simply staying invested often yields better returns than attempting to time the perfect trade. Missing just the 10 best days in the market over a 20-year period can cut your returns in half. Half, just because you tried to be too clever. The truth is, time in the market beats timing the market. And once you accept that, your entire relationship with investing changes. You stop chasing, you stop reacting, you start building. Most investors think of risk as volatility, but that's not true risk. Volatility is just movement, noise around a trend. True risk is permanent loss of capital. When you sell during a downturn, you're not avoiding risk, you're creating it. Because now, you've locked in a loss that would have recovered over time. If you zoom out far enough, the stock market is one long upward line, interrupted by temporary declines. But when you're zoomed in, day to day, week to week, those fluctuations feel enormous. It's like watching waves crash on the shore without realizing the tide is still rising. That's why perspective matters. The wider your view, the calmer you become. Because you stop reacting to waves, and start understanding the ocean. Mastering your emotions doesn't mean ignoring them. It means recognizing them for what they are: signals, not commands. When you feel fear, it's your brain warning you of uncertainty, but uncertainty is the price of growth. Every great investment story is born from uncertainty. So instead of trying to eliminate fear, learn to act despite it. Build systems that protect you from yourself: automatic investments, diversification, clear time horizons. Because discipline isn't about being emotionless, it's about being consistent. Ray Dalio calls it, pain plus reflection equals progress. Every time you panic and sell, reflect on it. Ask, what triggered that reaction? What story was I telling myself? Over time, you'll start to see patterns, and once you can see your own mind clearly, you become unstoppable. Here's the paradox. The very moments that feel the most dangerous are often the most profitable. When fear is highest, prices are lowest. When confidence is highest, risk is greatest. That's why most fortunes are made in bear markets, not bull runs. But the human mind resists this logic. It feels wrong to buy when the world is collapsing. It feels smart to sell when everyone else is scared. Yet, that's precisely when discipline pays off. The key is to build a philosophy that's stronger than your emotions. Because when the next crash comes, and it will, you'll need something deeper than optimism. You'll need conviction. At the end of the day, investing is less about markets and more about mindset. The charts may change, the headlines may shift, but human nature stays the same. The 80% of investors who panic and lose money aren't victims of bad luck. They're victims of untrained psychology. They're trying to play a long-term game with a short-term brain. But if you can understand your own impulses, if you can master the art of doing nothing when everyone else is losing their minds, you'll find yourself in the top 20%. Not because you had better information, but because you had better control. The market rewards calm, it rewards patience, it rewards those who think in decades, not days. So next time the headlines scream chaos, remember this: markets recover. Fear fades, but discipline, that's forever. And the ones who understand that, they don't just survive the market. They own it. So the next time you feel that pit in your stomach, that urge to sell when prices dip or to chase when they rise, remember this. You're not fighting the market, you're fighting yourself. Master that, and you'll do what only 20% of investors ever manage to do, win the game everyone else loses. Awesome, we made it to the end. I truly hope you got some valuable insights from this video. If you did, smash that like button. It tells me you want more. To stay in the loop and never miss out, make sure you're subscribed. Click that button and the bell icon. Now, I'm super curious to know what you think. Drop your comments down below, let's chat. Your support means the world, and I can't wait to connect with you in the next one. Take care and have a wonderful day.